So the implications of all of this, for if I'm, either a normal investor or just a normal consumer, I'm already seeing higher mortgage rates, higher financing costs for if I want to purchase a vehicle, for everything, right? So what does this mean? What are the implications then if you don't have these buyers coming in to buy treasuries? What then is the ceiling for yields?
So I that's the question right now. I think what will happen, well, first of all, the implications directly is that as yields go higher, that's going to be pretty negative for the economy and for the rest of the financial assets. Now, as yields go higher, we can think of as people maybe instead of buying cookies, maybe they'll buy some fixed income. And of course, as yields go higher, if you are someone buying a house, your mortgage rates are going to stay very high. If you're a company that eventually wants to refinance its debt, you're going to have to pay higher rates too. So I think that's going to be a drag on the economy and eventually push us towards recession sometime in the second half of next year. Honestly, I think yields top when the Fed steps in because there really is no other buyer available to buy all these coupon treasuries and other than the Fed. Now, you can have some big accident in the markets forcing a big risk off play, but longer term speaking, I think the only game in town is the Fed as someone that is more active in the markets. Maybe something along the lines of like the Bank of Japan. We're not there yet, but I think that is the ultimate end game for monetary
So,
policy here.
so this is really interesting, Joseph. So what you're saying is it's not that yields stop going up when the Fed stops raising rates. That's been something that people talk about. It's when the Fed actually comes in and starts buying treasuries again.
I believe so. Yes, I think that. So just okay. So like I said, I look at things through the lens of supply and demand, and from my analysis, the demand is really maxed out at this point, and but the supply is, for all intents and purposes, infinite because we have a significant fiscal deficit that only grows larger. So eventually, I think yields start topping out when there's more active involvement by the Fed, not by cutting rates, but actually being actively involved in the treasury market as a buyer.
And so do you think then that, the consensus at this stage seems to be indeed that the Fed's going to start cutting rates maybe in the second half of next year? That's something the dot plot has seemed to gesture at as well. You think it's more likely that they will come in and do this kind of action versus a straight up cut, or would they come sort of in tandem?
So I think I view these two actions as separate. I think that when they go and maybe perhaps buy treasuries or even stop quantitative tightening, I think they will view it as more of a market functioning aspect, as in, there's some technical matter, maybe we have to go in and fix it and it will be okay. Similar to what they did with the repo market in 2019. So repo rates spiked tremendously and they added some facilities and added some liquidity and thought the problem would go away. When they're actually adjusting the overnight rate, like you mentioned, that's changing the stance of monetary policy. I think they'll perceive that to be something separate. And yes, I agree that they will be cutting rates sometime next year as the economy slows and as inflation gets under control. But I would view purchases in the treasury markets as separate from changing the stance of monetary policy.